Good afternoon. It's Jeffrey Christian. It's about 12:38 on the afternoon of Tuesday, the 21st of March here in New York. I wanted to talk today about interest rates and some of the problems that have occurred in the banking industry. There are similarities to what's going on in March of 2023 to what was happening in March of 2008. And I think that some of those similarities or maybe bear some important information about what to expect with gold and silver prices over the next several years. In March of 2008, gold prices surged over $1,000 from around $900 as Bear Stearns went bankrupt and the Federal Reserve and Treasury engineered a takeover and assumption of Bear Stearns' assets and debts and operations by J.P. Morgan. In that kind of environment, and we'd already had a couple things, including Northern Trust in the UK, bank problems. We were 5 months into a recession, although we didn't realize it at the time. In that situation, the price of gold spiked. Silver spiked higher. And our comment to our clients who had been buying gold, $300, $500, $600, $700, $800 an ounce, was to stop buying and wait for the price to fall back to $900, which we expected at some point in the next 2 or 3 months. We told our clients to actually buy puts, $900 puts, with the August contract, with the expectation that the price would fall back to 900 or lower, and they could sell those puts at a nice profit and then resume purchasing physical metal. Our view had been that we were headed toward a recession and a financial crisis probably in 2009. We were wrong, and as I said, we were already in a recession by March of 2008, although a lot of people didn't realize, including CPM. The storm subsided for a while. Prices did go back down below $900 briefly, I think April, May. And then September of 2008, you saw another wave of financial distress. Lehman Brothers went bust. That time, the Fed and the Treasury let it go. They started pouring trillions of dollars into the banking sector to shore it up rather than spending hundreds of billions of dollars to shore up the mortgage market. Former Secretary of the Treasury Paul O'Neill, Alan Greenspan, current FDIC at the time Director Sheila Bair, all were saying, don't do that, shore up the base, the mortgage market, and then you can price the derivatives based on those mortgages, and you know how the banks are in terms of profitability. But for whatever reasons, the Treasury didn't do that. They poured trillions of dollars into the banks and shored them up and let everybody else suffer. And they're still paying the consequences of that action. There are many important corollaries there, but the one that I want to draw in right now is Bear Stearns was the foothills of the financial crisis that really erupted full force in September and October of 2008, like 6 months later. We have been saying that we thought that things would get worse politically, financially, economically in the fourth quarter of this year or in 2024. And we still hold that view. We think that what we've seen over the course of March are the foothills of that. And it's very interesting because somebody was interviewing me this week and said, Jeff, you have been saying that there would probably be problems in the financial markets and volatility and instability, and here it is. I said, well, this is, I think, just the first shot. But you have to look at the specifics, and there are quite distinct differences between Silicon Valley Bank, Signature Bank, First Republic, and Credit Suisse. And when I talk about the title here, was it interest rates or incompetence, and does it matter? I'm really thinking about Silicon Valley Bank. which really started the ball rolling. And I'm not sure that it does matter, because I guess a good, solid system can survive incompetence on the part of bank managers. But a volatile, risky, increasingly fragile financial system really needs competence across the board. And one set of incompetent people can really spoil the whole basket of apples. So I want to talk about interest rates primarily as opposed to gold. Now, interest rates should be viewed in perspective, and I've talked about this in the past. The green line here is the nominal T-bill, and you can see it has been rising from virtually zero, 25 basis points, up to about, I think it's about 4.5% right now, 4.75% in that range. And you can see that while that's been a very steep rise, it's still at a level that is far lower than it was for most of the period of time from 1968 until, say, 2002. We did see interest rates start to fall in 2002 and come down. They rose into the Great Recession, early 2008, and then they came back down and they were zero for a long period of time. The orange line is the real inflation-adjusted rate. You can see it dipped negative really around 2002, and it came back up a little bit, but it has been negative for most of the period of time since 2002. That's 21 years. A long time. You can see that real interest rates are coming back up sharply, and they're still negative. And you can see the gold price, which basically had been relatively moribund from, say, 1994 until 2001, started to rise. And as interest rates went negative, gold prices started rising. Inflation wasn't an issue back then, but a lower dollar from 2002 into 2006 or so, gathering debt problems, gathering higher oil prices, the U.S. invasion of Iraq, a variety of other factors all came in and caused people to say, I think I should have more of my wealth in gold. So from that perspective, it's very important. Now, I want to point out something else. When the interest rates were dropped to virtually zero in 2008, CPM Group's view for a couple of years was that at some point interest rates would have to rise, and probably would have to rise very sharply, partly because of the U.S. Treasury gathering debt, which was already a big problem by 2008. Around 2010, we shifted that perspective, and we started to say that interest rates could remain low for a very long period of time. We said maybe even a decade or so, or longer. The Fed actually came along afterward and said publicly, they had probably been saying it privately before that, that they too saw an extended period of low interest rates. They started to try to raise rates around 2015-16. It didn't work, and they had to drop the rates back. And now they're raising their rates. And that decade-long period of abnormally low interest rates seems to be over now. And we are moving toward not normalizing interest rates. And you can see that we have a long way to go before we, quote, normalize interest rates, if we were to normalize interest rates, because normalized interest rates were 6 to 8% for much of the last half century, the period of free gold prices, and the period of free dollars, and the period of massive creation of paper assets. So we do seem to have come out of that long period of low interest rates, and we are moving into a period of higher interest rates. And this is something that people have been talking about for decades, for a decade, for years and years. And the Fed has been far more transparent and forthcoming with information about its thinking, short-term and long-term, than the Fed has ever been before. Alan Greenspan began a period of transparency, increased transparency at the Fed, and it has continued through Jerome Powell. Interest rate increases have to be put in perspective, though. They're still relatively low. And the fact of the matter was this was coming. Everyone saw it. Now, interest rates are important. But what's even more important is why interest rates are rising now, or why interest rates rise or fall in general. This is a scatter plot of changes in the real gold price and changes in real interest rates. You see it's all over the board. There's a negative 16% correlation. So, in other words, higher real interest rates only correlate or suggest that gold prices should be falling 16% of the time. It's all over the board. There are times when they're both rising, times when they're both falling, times when interest rates are rising and gold's falling, times when gold prices are rising and interest rates are falling. What really matters is what are the factors behind the changes in interest rates. If investors, if the broader financial market thinks that interest rates are rising because inflation is high and it's going to be very hard for monetary authorities to control that inflation, then it's positive for gold. Higher interest rates mean that the financial markets and investors in general view inflation as being a big problem that monetary authorities cannot control. If, however, interest rates are rising because the financial markets interpret that and say, the monetary authorities are effectively fighting inflation, and inflation is falling, as it has, in fact, for the last 8 months, without throwing the United States or the world into a recession, then rising interest rates, real and nominal, can be negative for gold or can negatively correlate with gold because there's a different independent variable affecting both interest rates and gold prices. So what really matters is why are interest rates rising or falling? And right now, despite what the financial markets think, the Fed has been fighting inflation and fighting it relatively effectively. You have other pressures, as I've talked about in previous videos, that are much more important. Fiscal policy is still extremely stimulative and inflationary. Strong demand for goods and services from both consumers and businesses, although we're starting to see that cool more strongly in some sectors like housing than in others. And you're starting to see glimmers of supply constraints in various segments of the market, including housing. So interest rates are rising right now, partly because, despite what the markets seem to think, monetary authorities are relatively effectively dealing with inflation. Now, the gold touters, people who have been telling you for 40 years that the financial system was going to collapse, the dollar was going to collapse, the treasury market was going to collapse, they're like drooling right now, saying, oh yeah, you see, it's all collapsing. I've been right. Okay, I was 10 or 20 or 40 years early, but I was right. Well, they're not. They're not right now. They haven't been right then. And inflation is not going into hyperinflation. We're far from hyperinflation. Inflation actually is cooling. It's not going back to 2% right away or anytime soon, but it is headed in that direction. It's not headed to higher rates. It's not headed to 15% inflation. So the monetary authorities seem to be doing their job. And you're starting to see that. Today, gold prices are off about $32 from yesterday's close as I speak. Silver's off sharply too. They had risen during the bank crises, but they've come back off. So we think that what we've seen here is what we've been talking about all along. Strong gold and silver prices in the first quarter, coming off as everything sort of stabilizes for a while in the second and third quarters, and then rising again, possibly as early as the fourth quarter and maybe into 2024. So what we've seen in the banking community over the last few weeks fits in perfectly with this model that we've had of the global economy, the global financial system, and gold and silver prices that we've been talking about for the last 8 years or so. Sort of where it is. A few words about incompetence. Those of you who have listened to these things know that I have talked a lot about how state-chartered banks were not really regulated by the states in the period prior to the creation of the Federal Reserve Board. And again, there are a lot of people who say that the Federal Reserve Board is evil and that it causes all kinds of stupid things that it doesn't really cause, and that the global economy and the U.S. economy have been much more volatile since the Fed was created, none of which is true. And in fact, the economy was much more volatile before the Fed was created, and that's why the Fed was created. And it was volatile because you didn't have nationally chartered banks. You didn't have a central bank. You had state-chartered banks. The states didn't really regulate them. And those state-chartered banks, managers and owners realized that they could write script, bills, and not have deposits behind it. I was listening to somebody who was talking about the good old days before the Fed, and he was acting as if the bills that were issued by state-chartered banks prior to the creation of the national banking system were in fact 100% backed by assets in the bank's vaults. And that's not true. They're supposed to be backed by a certain percentage, fractional reserve currency, the way these guys like to talk about it as if it's gonorrhea. But in fact, the banks knew no one was overseeing their books, and they didn't really need to have assets in order to write bills. And so you'd have an excess amount of cash, and then people would say, wait a second, I don't think there are any assets there. There'd be a bank run, and that would often throw us into a recession or a depression. We had 3 depressions in the 1870s, 1880s, and 1890s. We had 60 months of recession between the bank panic of 1907 and the end of 1913. It was much more volatile. I bring all that up because Silicon Valley Bank was a state-chartered bank. And the state was supposed to be monitoring it and auditing it and checking things. The Fed also had some oversight, and then the fact the Fed said, hey, wait, you have real problems here, deal with them. But they didn't have a risk manager for close to a year before they failed this month. They didn't even have a CFO, Chief Financial Officer, for several months. Now, everyone should have known that interest rates were rising. Fed made it very clear they were going to do this. Interest rates actually started rising in March of last year, about the time that Silicon Valley Bank got rid of its risk manager and didn't replace him right away. Silicon Valley Bank ought to have known this was coming and taken the proper steps to protect itself from rising interest rates. It did not. So, you want to blame the interest rates? Yeah, that's a hard argument. You want to blame incompetence on the failure of Silicon Valley Bank? Yes. You probably should also throw in the fact that there is a very prominent person for whom I have absolutely no respect, who sent a tweet around saying, hey, get your money out of Silicon Valley Bank. We need to have a bank run on Silicon Valley Bank because it's not in good shape. Which apparently was not illegal because it was true. You can say bad things about banks if it's true. But that's beside the point. You look at Sovereign Bank and First Republic and Credit Suisse, they didn't have the same problems that Sovereign Valley Bank had. They had other problems. And if you look at all four of them, what really destroyed those banks was not so much people withdrawing cash, except to some extent it was, but really it was a matter of a withdrawal of money invested in the equities of the banks. That's really what did Credit Suisse in, was that its main investors decided to get out. And it was really the equity of the banks that did them in. What's all this mean for gold and silver? It means that maybe we are in the foothills of the financial crisis and recession that CPM Group has been warning about for years, that we've been saying we expected to emerge around 2024. And I think that's where we are. We'll have more information about this next week. CPM Group will be releasing its 2023 Gold Yearbook. Here is the 2022 one. Nice, big, if you have those sticks on key pages. We will have an online briefing that you can register for at our website, cpmgroup.com. It's a free briefing. It'll probably last about an hour, March 28th, a week from today, online. And you can buy the book. You can buy the book online. You can pre-order it. You can wait for it there. And then a week later, we're going to have an open forum for clients where clients can send in questions, or they can type in questions through the webinar system as we speak. No fixed presentation, just there to answer questions and issues as people might ask them of us. In the meantime, you can go to our website. You can get free reads. You can see videos. You can read about our reports. You can order our reports. You can say, hey, give me information about the retail investment program. I think I should be your client. We'll talk to you on Friday, and then we'll talk to you again next week. In the meantime, take care of yourself and those around you, and try to do something nice for the whole world. Take care.